Hi there folks, and welcome to another weekly general update for the 28th and 29th of January. It was a pretty big week last night. Last week. It was quite a few confirmations, quite a few good positive moves. So we'll have a look at those because I think there was quite a lot of instructive information came out of last week. So just before I start, just the normal important information on the license and on the general advice nature of this video. So a summary of the action for the week. The S&P finished about flat for the week. I think it was might have been down by 1 point. So a pretty flat week. It's still overbought in the short term, and we've still got this battle between sentiment indicators being overbought, momentum indicators being overbought, and seasonality is also against the market, but there is obviously an enormous amount of money that wants to come into the market, and for the moment, momentum is still winning that battle. Sentiment indicators are quite bullish, but they're not yet extreme, so we could see the market move a little bit higher yet before we get a more significant correction. And I'll have a look at the charts and indicate where I think that correction might come from. We can normally expect some weakness in the second half of the reporting season. That happens so often, and we're basically just going into the second half of the reporting season now. So basically any day I think we could expect a little bit of a turn down. It's possible we've already seen that if it's going to be a really shallow one, but I still think we've got a chance of at least a few days more downside. However, the medium-term target is 1365, and I would then expect a correction back from there, and that could take us down to just below 1300. And from there, doing a bit of crystal ball gazing, if markets behave in the way that they normally do, then our next target would be probably about 1440. So I think over the next few months there is still some considerable upside in the US market, but expect volatility. There's still a lot of decisions coming out of Europe that can move markets in a matter of minutes. So it's not going to be plain sailing, but I think that's the overall direction. And now the US dollar index, which is obviously a key influence on stock markets, it had got very short-term overbought. The fact that the US stock market had held up with the US dollar going up is also a pretty positive sign for the stock market. So short-term overbought, it's unwinding. It's probably gone as far down as I would think it's going to if it's going to continue its uptrend. So any lower, I think the upward move is finished for probably quite a few months. And if that's the case, then that's very positive for stocks, and it's very positive for commodities. Now the Australian market for once did do better than the US market, and it actually rose a bit over 1%, or about 50 points on the week. And the really good thing that we saw last week is that small caps are now starting to see more momentum coming back into them. And of course the Shanghai index continues to confirm the uptrend in both the US and Australian markets. Now gold was up by $70 on the week. There was a huge intraday reversal on Friday, and it finished very powerfully. It got down under 1700, reversed back up again and finished on its highs. So gold looking very strong. Now short term, it's also overbought, and I've got a 1767 target. Whether we go straight up there from here, which is another $30, or whether we get a bit of ups and downs for a few days, I'm not sure. But I think at 1767 we may get a more meaningful retracement back into the 1600s. So that'll be another opportunity for us to load up on gold and gold stocks. Now silver was up 5% last week. Was up another 5.3% this week. So silver really doing quite well, and it is also now short-term overbought. We've got resistance at $35. We're currently trading in the 33s at the moment. I would then expect a pullback from that resistance, and we'll have a look at all those charts in a minute. and then move higher and probably push up beyond $40. Copper also clearly back in uptrend, so that's very positive for commodities, very positive for stock markets, and again closing in on $4. Now just a few general comments. I believe now with what's happening over the last month or two that the threat of any sort of significant market correction or a crash like we saw in August of last year and obviously like we saw in 2008 is probably gone for now. The ECB, European Central Bank, has just created 500 billion euros. And I say created, it's another word for money printing. It's just out of thin air. It's not backed by anything. And there's another lot planned for late February. So in another 4 weeks there's going to be another amount, and some of the numbers I've seen being trotted around up to $1 trillion additional funding for money creation. The Federal Reserve has just come out last week and said they're holding rates at 0 to 2014. Now, there's two ways to look at that. One, you could say, well, that's great and it's going to create a lot more liquidity into the market, a lot more of a carry trade is going to be going on. But then the other way to look at it is to say, well, if things are improving, why would they do that? Why would they signal holding rates for another 3 years? Why not just do it 6 months or 1 year at a time? So clearly things in the housing market in the US are not nearly as good as they should be. However, the liquidity must feed through to commodity prices, and it will feed through to stock prices as well. And every time that the S&P dips, this has been particularly noticeable in the last week, every time it dips intraday, there are buyers coming in and it's closing well off its lows. So there's clearly a lot of buying momentum in the US market at the moment. Just looking at American corporate health, the reporting season has been a bit mixed, but there's been some absolutely stunning results from some of the majors, and no more so than Apple, whose revenues for the quarter were up 73% on the previous corresponding quarter, and the profit margin increased to 45%. Now, 45% profit margin for an industrial company such as Apple is really quite extraordinary. And they've now got $100 billion in cash. So there are some other companies that are along the same lines as Apple. So there's certainly some bright spots in corporate America. Now last week I wrote these things, and I was talking about gold. Once the price starts to rise, it will do so quite quickly. You'll see on the charts we did have quite a significant week. The movement in silver will be even more explosive, and we certainly percentage-wise have had a bigger move in silver, but I think the really explosive move's yet to come. I also said that gold stock prices will join in, and we'll almost certainly see huge gains over time. Now, last week we saw in the US the ETFs for the gold miners, the major gold miners, GDX, and the junior gold miners, which is GDXJ. They started to move significantly for the first time. We'll have a look at those charts. So we saw both those things last week, the price of gold and silver starting to move quickly and stock prices starting to join in. And we also saw Aussie gold producers have a pretty solid week as well. So I really think we're on the cusp of some major movements, particularly in gold and gold stocks. So we've had to wait a fair while for it, but I think the time is finally here. And just finally, this is the Italian 10-year bond yield, which is obviously pretty critical. Anything above 7 is a real issue, but you can see in the last 2 weeks that the Italian 10-year bond yields have really come off quite hard. They're now down under 6%, and this is largely a result of the $500 billion that the ECB basically made available to banks in Europe. So let's hop over and have a look at some of the price charts, and we'll start first of all with the US dollar index. This is on a weekly chart, And you can see we were in quite a good uptrend. We got beyond the 50% retracement. We didn't quite make the 61.8. It's turned down fairly hard. We've had two significant weeks. You will notice that the momentum indicators are heading down. MACD definitely rolled over. So to me, it could still turn up from here. We're now back down to this peak that we had in October. If it holds this level, then we're a chance of heading back up to 82.5 and possibly 88, and that won't be good for stocks, and it certainly won't be good for commodities. And for that to happen, it would require something significantly to go wrong in Europe. However, if the US dollar does continue down in the next week below this level, then I think you can say that it's heading lower, and that's very positive for stocks and commodities. Now let's have a look at the S&P, and we'll start with, just have a look at a weekly chart. So you can see big picture weekly chart, quite clearly an uptrend. The momentum indicators moving higher, but not particularly overbought at this stage, so there's certainly room for that to move higher. Now let's have a look at this chart, which has got just a little bit messy. I'm looking at these levels up here, around about 1365, as probably capping out this current move. Now just looking very short term, because the market is overbought, you can see the RSI really quite high and just starting to roll over. So if we got a retracement of this run from the 19th of December to a couple of days ago, then at the most mild scenario, we're looking at 1302. We got down towards there on Wednesday, but more likely 1283. So that's the area that I'm looking at, and I would probably be a significant buyer if the market does get down to that level. But it's possible it could just continue on up from here with an ultimate target at about 1365. So that's the S&P. Now if it does play out in that way, 1365, I would then expect a more significant correction back under 1300 again, and then a more major push up to 1440. So that's how I see the S&P playing out over the next couple of months. This is the Aussie market on a weekly chart. You can see we've broken out of that triangle now. Momentum indicators are heading up, so that one's looking quite positive. And we'll just have a look at the small ordinaries market in Australia, and you can see we've had quite a good push higher in the small ordinaries index since the start of this year, since the 3rd of January. Haven't been too many down days. It's been pretty much higher all the way through. Now let's finally just have a look at gold and silver, and we'll look at gold initially. Let's just go to a weekly chart first. So weekly chart, you can see held this long-term trend line, pretty powerful week, and the RSI now about mid-range, so we've still got more upside to go yet. Just clicking into the dailies. I'm looking at there being some resistance around this 1767 level, because that would be the 61.8% retracement of the whole run from the peak at 1920 to the low in December. And that also corresponds to these little highs here in early December as well. So 1367 is a pretty logical area. So we may just see gold meander higher for the next couple of weeks. You notice that it is overbought, but the momentum indicator, the MACD, is still heading up and not showing any signs of rolling over yet. So that's why I think there might just be a bit more upside in gold. And then I would expect a bit of a correction back, maybe to the 1650 area, and then a push on towards 1900, 2000 and beyond. So that's the scenario with gold. Now with silver, I'm looking at around about $35, which corresponds to these highs here and the 150-day moving average. I would expect some resistance around that level at 35 and then get a bit of a pullback and then set up for a more significant run to beyond $40. So that's how I see markets for the time being, and I'll go into more detail on the specific stock opportunities in the members chart update. So that's it for this week. Cheers.